let's continue with the next chapter, being the 3 building blocks of every single trade. And it's very crucial. It's very important to understand the anatomy of every single trading setup. Because if you don't understand these 3 components, you're pretty much gambling on the charts. And this is something that we want to avoid or minimize, okay, as much as possible when it comes to trading. Please keep in mind that the trading setup in itself, or in the essence, is universal. Regardless of the market, regardless of the trading direction, whether you want to trade on the way up or on the way down, it will always remain the same. The anatomy will always remain the same. Okay, so in this case, we can take a trading setup where we anticipate prices to go up, as in we are interested in taking a so-called long trading setup, but we can also obviously anticipate prices to go lower at some point, and then we can take a so-called short trading position. And again, in this case, these blocks, so to say, which consists of a red zone and a green zone and a white horizontal line in between. This is a visualization of a trading setup. As you can see, it's pretty much the same, it's similar. However, I have visualized it by making use of an indicator within TradingView, but this falls outside of the scope. So let's just take a long trading setup. What I'm pretty much saying here is as follows. So first of all, is very easy to understand, which is your entry. And this is pretty much equivalent to the desired place or price where we want to take a trade, or where we want to buy or take a trade. That's pretty much what we are saying here. So for example, hypothetically speaking, and in this case, I'm just going to draw some price action. I'm going to invent it out of nowhere. Let's say price was hovering at this point. Eventually, when price comes to this point, okay, this circle, and let's just have a look at the prices on the right side on the y-axis. Pretty much what I'm saying here is that whenever Solana, in this case, goes to 157, that's the exact place where I want to buy or take a long trading setup, okay, which is very important, of course. This is one of the 3 key components of every single trading setup. Then the second one, being one of the most important ones as well, is the so-called stop loss or invalidation. And in this case, I'm referring to the red box within the block, okay? This is what we can consider to be an emergency break. An emergency break. And whenever price touches my invalidation, then my position will automatically be closed, so we don't lose more money than we have predetermined. Okay, you need to understand, when it comes to trading, it's very important to always make use of a so-called risk management. Okay, always apply a stop loss or an invalidation, because if you don't do this, you pretty much risk your entire capital, or you risk more than you have predetermined, and that's the best way to lose your underwear. And we don't want to do this, okay? We want to always take into account risk management, because this is pretty much the only or the single edge that we have versus the market. Because at the end of the day, after having performed a technical analysis, it's up to the market to decide whether we were correct or we were wrong. And that's also the probability. You need to understand that whatever we do to the best of our capabilities, okay, we can never attain or achieve a 100% win rate or success rate. Getting losses, getting stopped out, losing money is an inevitable and very unfortunate part or aspect of the trading game. And that's something you need to understand, a probability game, okay? But in this case, so hypothetically speaking, whenever price was coming to 157, that's the place where I wanted to buy or take a trading position with the expectation to go up. But unfortunately, what happens, the market decides to go lower, and it decides to go lower than this red box. So in this case, whenever price gets below 155.91, that's where my position will automatically be closed, and that's where I will take an L. I'm going to lose some money. I'm giving this money back to the market, and then it's just set and forget and wait for next opportunities. So this is a negative scenario where unfortunately we take an L. However, we can obviously also have a positive scenario, and then in this case we got the so-called, which is the third and the last component, the take profit. And this one is very important because, and then I'm referring obviously to the green zone or green area within this tool. This is pretty much the place where I automatically close my trading setup for profits, okay? So whatever we were risking on beforehand, whatever risk we had defined, we can obviously also win money. You need to understand when you can lose, you can also win. It's very important to understand where you want to take your profits, because obviously if you only know the first two components, that's already a big advantage. However, and this might sound like a very weird example as well, but if I'm a captain on a ship, I want to know my destination, and I also want to know where exactly or how I exactly need to go to my destination, okay? If I want to go from the Netherlands all the way to Africa, I can't sail without any compass, okay? I need a compass. I need like a starting point, I need an end point, and that's also something similar in relation to the trading setup. I need a starting point. This is my starting point, point number A, and whenever, you know, price tends to go up to the desired direction, this is what I consider to be point B. And whenever we reach point B, that's where I say, done deal, thank you market, I'm going to realize the profits, I'm going to put the money in the pocket, and we move on to the next trade. So these are the three key components of every single trade: your entry, your stop loss or invalidation, and your take profit target. Now you know the theory. Let's apply it into practicality, and I will also give you a couple of beautiful examples and a couple of good tips that you need to take into account. Before giving you some examples, let's refer once more to the reversals. And I understand, you know, at a certain stage you're like, bro, what? Again? Reversals? Yes. This is the essence, this is the core, this is where it all revolves around. But there are a couple of things that you need to take into account, especially when we want to integrate the trading tool, so to say, and we want to apply it on the reversals. Again, this is the previous low, the swing high, also known as the move to the low, because from this point onwards, this local peak, we are creating a lower low, a local bottom, and then from this point onwards, we create this gain. This gain is a very first signal, a sign of strength, and that usually tells us that something is cooking, okay? But how or where do we exactly want to take the trade? Again, you need to take into account that whenever we are gaining, that we need to remain disciplined and we need to remain patient. But whenever price happens to give this small pullback or retest, retracement towards our so-called previous low or level to hold, which in this case is similar to 141K. I'm just referring to these prices on the y-axis. Bitcoin has never been to 140K, but it's just to give you an example, okay? The box is in itself where we want to take the trade. However, how do we determine our invalidation or stop loss, and where do we take the profit target? Again, we want to sail with a compass, okay? We need to know, if we are the captain of this so-called trade, we need to know where our destination is. What is very important to understand, this part that I'm going to highlight, this is what we consider to be the lower low. Whenever we are taking this trade, and especially after having received the gain, we are anticipating that price is going from a downtrend to a potential uptrend. The keyword being potential, because again, it's a probability game. We are never working with 100% certainties or guarantees. What is very important, especially for pretty much everything, you need to take your stop loss, or you need to place it for 75%. Place your stop loss at 75% of the tail or the wick of the candlestick that made the lowest point during the reversal, the lower low. Why 75%? This is just to give you, to guide you, to give you a tip which allows you to give your trade some breathing room. You need to give your trade some space and some room to do whatever it needs to do before giving the anticipated surge or pump or whatever you would like to call it. Because what happens, many people, they tend to so-called micromanage their trades. So they take a trading position whenever price touches the box, but whenever price is going a little bit like this, they are already getting stopped out of their position, which should never really be the case. And because you're placing your stop loss or your invalidation for 75% in the wick of the lower low, again, you're giving your trade some breathing room, because what can potentially happen? You need to understand the way, even though it's visualized like this, theory versus practicality. There's a world of difference, okay? Sometimes what happens is that whenever price comes to this box, Eventually, of course, it might give the pump, but it will give a pump maybe first by doing this. You see? So in this case, you won't be bothered by these small price movements on the way lower, okay? Because again, you have given your trade plenty of space to breathe. And it would be unfortunate, okay, if you micromanage your trade, you put your stop loss somewhere here, you get stopped out, and then it starts to move. And trust me, I've had this plenty of times. This is one of the worst feelings ever. So you were correct with your analysis. You were correct with your bias, okay? But then again, you just mismanaged your trading setup and you micromanaged it, resulting in a loss, which should never really be the case, okay? So keep in mind, this is my number one tip when we are taking a trade, when we are seeing reversals being created. And then the last one, this is also something that you need to understand. How do we define our take profit levels? They are actually, this is also a very important something to understand. So in this case, and then we are going to mix a couple of different, concepts. We are always looking at so-called untested levels in the chart. So again, this part is what we consider to be a gain, a confirmation of a gain of a level. But within this circle, whenever price tends to give this small pullback all the way to the previous low, you need to understand that from this point to this point, we are breaking through levels without retesting them. And that's what we consider to be an untested level. So if we know the entry, and most importantly as well, the take profit, then we have a clean, a clear, a proper trading plan. That's how we want to apply. Yeah, that's how we want to trade. And we should always try to focus on 1, 2, 3 risk, 1, 2, 3 risk reward setups. And this is something that's also new. It's also actually part of risk management, of course, but it pretty much tells you that, for example, hypothetically speaking, let's say you have a capital of $1,000, okay? $1,000. It's very cliche to say, but whenever we are taking a trade, we should never really aim for risking more than 1%. Everything between 0.2 to 0.5% of your trading balance is good. If you really feel like you can upsize a little bit more, or you feel a little bit more confident, then you can definitely increase the risk to 1%, but keep it like that, okay? Especially in the beginning, because again, you need some experience, you need to make a lot of L's, you need to learn a lot from your mistakes as well. So in this case, what I'm pretty much saying is I'm risking $10 in case my price or the market doesn't do what I intended it to do. But whenever price hits my so-called take profit target, I am earning $30. So for every $10 that I risk, I can potentially earn $30. And by focusing on 1 to 3 risk reward setups, that allows me, okay, to take multiple L's consecutively without even losing money, technically speaking, okay? So just bear with me for a second. Let's say we take 3 trades in total. Trade number 1, trade number 2, trade number 3. The first 2 of them being -10, because we're risking $10, but we were losing -10. So we are down $20, but then +30. Then at the end of the day, we are still profiting $10. So that's very important to understand, and that's also a key component of risk management. Always focus on 1 to 3 risk reward setups. Try to focus on 1% at most, okay? Risk at most to 1% per trade. That's something that you need to aim for. So this is just some general information, but most importantly, focus on these 2 comments, focus on these 2 explanations. So let's apply this theory into practicality. And I actually got a beautiful example on the daily. Again, what's happening from this point onwards to this point onwards? Let's identify the higher time frame trend. Very clear. We go from top to bottom, and price tends to go lower. But what do we see? We see a very clear level to gain, or a move to the low, my bad. This is what causes price to make complete new lows. So what do we need to do in order to break this so-called downtrend? We want it to gain the level. We need a confirmation of the gain, which comes in the form of multiple candlesticks above our level. 1, 2, 3, 4, 5. Again, it doesn't really matter which color the candlestick has. whether it be green or red, a confirmation of a gain is a confirmation of a gain. And then whenever price happened to gain, obviously we are very interested in taking a trading position within this box. Again, I have taken, or I have drawn this box by taking the bottom of the previous low to the bottom of the candlestick. And everything in this box is pretty much the probability that we play, okay? And it's up to you to decide where exactly you want to take the trade. So in this case, let's say, hypothetically speaking, I would like to take a trade over here. And this, as this is my lower low, I want to draw this, or I want to put my stop loss for 75% in the tail of the wick of the lower low, okay? So I've put my stop loss here for 75%, let's say somewhere around here. This is what I consider to be 75% of this wick. And then I need to determine the so-called untested level, or my take profit level. But as you can see, which is quite clean, it's quite clear, we have a specific level which we broke through, but we never really retested it on the way up. And then I'm specifically referring to this section, this piece of price action, okay? You've got multiple, to be very honest, but let's keep it a little bit simple. This is a level which I consider to be an untested level. We got up, broke through it, but by breaking through it, we didn't retest it. We didn't tap the level before going lower. So this is something what I consider to be one of my key take profit levels. So I have determined my entry, I have determined my invalidation, 75% in the wick of the lower low, and I've determined my take profit level, which is the untested level, a level that we break through but never really test. And as you can see, even though we didn't receive any reaction because we broke through it and eventually made new all-time highs, this is most definitely a very important level to take a profit of. Okay, so that's pretty much how we want to apply the trading aspect within the reversals. There are two other examples that I need to provide you in order to give you a full comprehensive explanation of the trading setup, the invalidations, etc. It's very important to understand this. So again, it's a little bit repetition. This is on Bitcoin, and this is what we consider to be a 4-hour reversal. Again, obviously, whenever we are gaining with multiple candlesticks, we are gaining our move to the low or swing high, we are very interested in taking a trading position. But this is a perfect, picture perfect, most textbook price action example where the reversal is being respected. So whenever price tends to come to this box, it most definitely gives a desired reaction. However, there's unfortunately no follow-up. So hypothetically speaking, if this would be considered to be point number A, this would be considered to be point number B, and this would be considered to be point number C, obviously it would be much nicer if we could immediately target point number C. However, you need to understand as well, even though we get a reaction, sometimes, as you can see as well, point number B is being respected to the T. Sometimes there's just not enough strength, not enough momentum or power being reflected in the charts that allows the market eventually to give a follow-up to the next checkpoint, so to say. This is a perfect example of not only realizing profits, okay, not being too greedy, not chasing the moon, but also taking into account your risk, or by applying or by defining a so-called stop loss. Even though it was hitting a TP, which allows you to be in a somewhat risk-free setup, which is a luxurious situation to be in, of course, you need to understand as well that, for example, if we were moon boys and we would only target for higher and we would be all in and we wouldn't take into account a stop loss, have a look at what happens whenever you lose the so-called previous low or this box. As soon as you lose the box, so to say, instead of being tapped out here, you would be underwater, so to say, and it would have been a very traumatic period for you, okay? So please be aware of the fact that you always need to apply a so-called take profit plan and a so-called invalidation plan, okay? These components are crucial for every single thing that you do and for all the future setups that you want to take. However, when it comes to Ethereum, and this is something that I would like to show as well on the 4-hour, it's a perfect example of a trade that went big, that went amazing. We are going to draw the reversal on the 1 or on the 4 hour. Okay, so again, we got to move to the low, because from this point to this point we have created a lower low. This is the previous low. We know for a fact that whenever we are gaining, and it's a lot of repetition, I understand, you've already heard this probably a million times already, but that's good. You should be able to dream this by yourself. We are very interested after the gain to play the probability whenever price happens to go to the box. We are going to apply a stop loss for 75% in the wick of the so-called lower low. But let's just deep dive a little bit and go to one time frame lower, okay? So we can see a little bit more details. You need to understand that actually on the way down, as you can see, there are multiple so-called untested levels. There are multiple levels which we broke through, but never really retested on the way up, okay? This is a very clean untested level. This is also a very clean untested level. So there are multiple untested levels being created. This one as well, okay? Just bear with me. These levels, they are very clean on the 4 hour, but whenever we are fine tuning the 1 hour, okay, we should actually make this an untested level as well, okay? As you can see, we've got multiple targets. If this is point number A, this is point number B, point number C, or point number D, and point number D, obviously you should be able to understand that we can't simply target point number D or checkpoint number D without taking profits along the way, okay? In order, which makes sense, which is very understandable and logical, of course, in order to go from point A to point D, we first need to go to point B. Then the strength, the momentum needs to remain intact. From this point onwards, we go to point C, and then eventually we go to point number D. So what you can do, okay, instead of just targeting point number D immediately, we can work with so-called take profit plans. So you just need to understand, whenever it comes to trading, we always work with position sizes, okay? And this is a term that you haven't heard before, and this is something that I will explain in the next module as well. But a position size is pretty much another term for where you say, I am going to open a position with 5 Ethereum, okay, worth of 5 Ethereum, okay? So what you can do, if this 5 Ethereum, that's my position size, This 5 Ethereum, this position size is equal to 100% of the position size, okay? And of course you need to understand this position size may vary in between the trades, whatever risk you have, that doesn't really matter. But you need to understand that whenever we have multiple take profit levels, so to say, because we are never too sure where the market is going to reverse or going to dump from, we can always say, for example, that we are working with a 40, 30, 30 take profit plan, or a potential 40, 40, 20%, 40, 20, 20, 20% profit plan. What do I mean with this? This means, okay, that initially, if I am opening my position with 5 Ethereum, which is considered to be 100% of my entire position size, on my first target, I'm going to profit 40% of 5 ETH. The second TP is going to be either 30, 40, or 20%. And then, of course, the remaining position size that you have left. Let's just focus on the first example. So hypothetically speaking, again, keep in mind 5 Ethereum, that's the center. That's the main number that you need to take into account. If eventually price hits this point, I'm going to realize 40% of 5 ETH. Okay, 40% of 5 ETH. 40% of 5 ETH is 2 ETH. This is what I have realized. So I've got 60% left, which is equivalent to 3 Ethereum. Whenever price happens to go to checkpoint number C, I'm going to realize my remaining 30%, okay? 30% of 5 ETH is 1.5 ETH. And then obviously, whenever eventually price happens to go to the last checkpoint, that's where we have realized the entire profits and we have realized the entire trading position. So this is also something that you can obviously do, because again, I have given you a very static, a very simple framework. where you can trade from point A to point B and then it's done. But you also need to take into account that you can trade along the way, you can take profits along the way, and you have different so-called take profit plans. And of course, this is something that you can just invent yourself. I'm just giving you a couple of plans that I have applied myself, a 40-30-30, 40-40-20, or even 40-20-20-20%. And this is something that you can definitely experiment with. And hopefully this is something that that's going to help you with your trading journey.